Hi everybody, welcome to our quarterly update from the alternatives business. I'm Sumaira Abdi and with me I have Gaurav Mehta. He's the equity CIO of the alternatives piece. So Gaurav, we meet again and in very, very turbulent times. I mean,
Absolutely.
every year we think is volatile, but this year more so. We've seen, the trade wars, and now, of course, there was this looming India-Pakistan war for a bit. But it's very difficult to predict what a leader like Trump might do. We don't know how India-Pakistan is going to shape up. But since you are the head of the asset allocation committee here at SBI Mutual Fund, how are you looking at playing this whole piece? What is the asset allocation like?
So Sumera, our belief always has been that it's always very difficult to predict short-term market moves, and which is why we fall back on an objective asset allocation framework. And this is a top-down framework that looks at valuations, earnings, and market sentiment. And I think when you look at any priced level of any security, it's a function of valuations and earnings. But I think what we also must realize is that things don't stay at fair value because there is so much of emotional investor emotions that are at work at all points in time. So in periods of exuberance, things overshoot. In periods of pessimism, things undershoot. So which is why apart from valuations and earnings, we also look at market sentiment and we quantify it to get some sense of market direction going forward. I think what's changed over the last 6-7 months, thanks to this correction, is that our readings on valuation as well as market sentiment have eased off a bit. So last year till about September, our valuation readings were very expensive, and we look at equity earnings versus 10-year bond yields. I think what's changed over the last 6-7 months is that there's been some market correction, there's been some earnings roll forward, so that's led to some PE contraction on equities. And equally importantly, and I think even more importantly, 10-year bond yields have moved down by about 60 odd basis points. I think they were 690, 95 earlier. They are now 630, 635. And this combination of a bit of PE contraction and a significant reduction in 10-year bond yields have now moved equity valuations back to historical averages. And when I say equity valuations, I'm largely talking about Nifty and Sensex as the frontline indexes. But those valuations from being very expensive are now back to historical averages. Alongside, I think the second thing that's changed is that our sentiment measure was extremely exuberant again sometime around September of last year. And that from a contrarian point of view suggests lower equity exposures. But I think again what's happened over the last 6-7 months is that because of this correction, sentiment readings have turned back to neutral, which means that now there isn't too much of greed in the markets and hence a lot of excesses have been eased out. I think both these are welcome changes, valuations turning average, sentiment turning neutral, and that suggests that now is back, that time when you go back to your long-term asset allocation. For a good part of last year, our asset allocation frameworks were suggesting underweight on equities. We are now back to neutral levels. Valuations are not outright cheap. Sentiment is not outright pessimistic to warrant a big overweight on equities, but at least you're back to neutral from being underweight. So not a time to be underweight either.
Okay. On the SBI AEON Alpha PMS, it has a significant exposure to mid and small cap stocks, right? And they have seen a correction, particularly in Jan and Feb. Is that worst now over? Do you think investors continue or they look at an exit now?
No, I think you're right that there was a big broader market sell-off in the months of January and February, and the smaller the company and the more illiquid the stock, the bigger was the correction. But I think when you think of small caps, you have to think of three different levels of risk. A is the business cycle risk. We don't think that we are necessarily in a very adverse business cycle. Yes, there was a bit of earnings slowdown over the last few quarters, but I think thanks to the RBI's triple easing on rates, liquidity, and regulation, we think that should put a downside lid to both economic growth as well as earnings growth, and things should start to recover from here on. So I don't think today business cycle is at a point where you should be thinking of that business cycle risk as far as small caps are concerned. Second, when you think of small caps, you also think of financial leverage. Now, again, balance sheet risk today is very well contained, not just in our small caps, but also small caps across the across the market. The debt equity ratios are significantly lower today than even versus the large cap universe, and which also means that that balance sheet risk is pretty non-existent at this point in time. The third risk which some people think of it as risk, some people think of it as just short-term volatility, is illiquidity risk. Now, when there is panic selling in the market, small caps tend to suffer a lot because anything illiquid goes down. And I think what we saw in the months of Jan and Feb was indiscriminate selling. I think, as I said earlier, right, market sentiment was very stretched last year, so there was indiscriminate buying, and as the pendulum swings, that led to sort of indiscriminate selling, where people were just selling everything irrespective of the underlying quality, and that led to a bit of correction in this portfolio, which is more skewed towards small caps. But I think, as we have been communicating in our monthly newsletters, when you look at the fundamental attributes of this portfolio, whether it's earnings growth, whether it's return on equity, whether it's financial leverage, it looks even better versus a large cap index like Nifty. And now, to answer your question, yes, we think that the worst of that panic driven climactic sell off is behind us. Uh, Whether things recover in a jiffy is anybody's guess, but I think market action will become much more stock specific. Investors will reward individual sort of stock performances in terms of earnings growth and balance sheet strength and cash flow generation. And I think as that happens, we are very convinced that this is a portfolio that should reward investors who show exhibit the right sort of patience to stay invested.
Gaurav, thank you very much for explaining all your alternative
My pleasure.
strategies. And I hope you found that useful. Thanks very much for watching. We'll see you again next quarter.